Welcome back to Cyber Trading University. My name is Adam Rosen. Very happy you could join us here today. It's 12:02 p.m., August 14th. Welcome back. Great that everybody could join us. Please take a moment to view our risk disclosure statement. And this is also available on our website at cybertradinguniversity.com. Please be aware that trading the options market or the Forex or stock market, like any market, entails a certain amount of risk, and we should always be aware of that risk, no matter what we do. A little introduction to Cyber Trading University for those of you that are new to our services. Cyber Trading University has been an educational trading institution since 1995. It established itself as a leader by first working directly with the SOES trading firms, that's the SOES trading firms teaching the day trade. CTU was one of the first to establish itself as a quality stock market trading school. Each of our instructors has a minimum of 6 years of actual trading experience before they begin to work with students here. And over the past 14 years, we have taught thousands of students to be successful and profitable traders. Cyber Trading University's headquarters are located in the heart of the trading world in New York. Now, this is part of a two-day event. Tomorrow, 10 a.m. Eastern, we'll be hosting part 2, and you'll receive an update, a reminder email as well, and you can register for part 2 at the conclusion of today's seminar. Now, what we're going to talk about today, it's called the option strategy pyramid. We call it the pyramid because there's 3 elements. There's 3 very important elements that we must know to trade the options market: price, time, and volatility. What we're going to do is discuss price, time, and volatility as it helps us find the appropriate strategy for any situation: buying and selling calls and puts, time decay, how to approximate the current state of volatility, how to buy insurance against naked options. We have a little bit of a quiz, and we're also going to talk about creating your own options trading plan. Now, again, the 3 most important elements to trade the options market is price, time, and volatility. When we trade the stock market or the Forex market, we don't really have to worry about some of these elements because we simply just want to buy a stock, and if the stock goes up, we make money. If it goes down, we lose money. Obviously, we hope this occurs over, the fastest amount of time, but generally speaking, we only have to really worry about direction in terms of the other equity markets and Forex markets. The options market has other levels that are in terms of time and volatility, which are crucial, and they can really be the determining factor whether we make or lose money on any particular trade. Now, going back to the basics just for a moment, when we talk about an options contract, there's 3 types of contracts: in the money, out of the money, or at the money. For example, XYZ stock is currently trading at $50 a share. A call option, which allows us the right, but not necessarily the obligation, to own that stock at $50 a share, it has a 50 strike price. Every option contract is a strike price. If we buy a call option, it's a bullish bet. In other words, if we buy a call, it indicates that we think that the stock is going to go up. A call option with a 50 strike price, assuming, again, the stock is $50 a share, is considered at the money, ATM. That means the strike price is exactly the same as the current market price of the stock. However, if the call strike price is below the current market price, it's considered in the money. It has intrinsic value. It gives us the right to own the stock at a price lower than the current market price. On the other hand, if the call option has a strike price of 55, it's above the current market, it does not have intrinsic value. It will only make money if the stock goes up to that level. It's considered out of the money. It does not yet have intrinsic value. The in-the-money options are always more expensive than the out-of-the-money options because, again, they have that intrinsic value. On the same note, we consider, again, the stock, $50 a share. We can buy a put option. A put option allows us the right, but not necessarily the obligation, to sell short that stock at that strike price, at that predetermined strike price, meaning $50 a share. If the option contract has a strike price that is exactly the same as the current market price of the stock, it's considered, again, at the money. A 45 put option is considered out of the money because when we sell short a stock, we hope it's going to go down. the stock is 50, we would hope it'll go down to 45, but it's not yet there. Therefore, it's considered out of the money. However, if we take a look at a put option that has a strike price that is above the market price, meaning if we sell short it, we have the right to sell short at 55, and the stock is already 50, it's already gone down, it has intrinsic value. In other words, the easiest way to think about this are the in-the-money options, are options with a strike price where the market has already been, meaning a call option. We buy a call option if we think the stock is going to go up. If the stock's at 50, it already was at 45. It's above that price. If we're talking about put options, then if the stock is 50, an in-the-money option would be above it. Out of the money is where we hope the stock will go. A call option, we hope the stock will go up to 55. In a put option, we hope the stock will go down to 45. Questions so far? It's pretty straightforward. The in-the-money options are always more expensive than the out-of-the-money options. And of course, if the stock, the market price of the stock is exactly the same as the strike price of that option contract, it's considered at the money. Now, as the price of the underlying stock moves, this affects the price of its respective options. As the stock price moves higher, call options will appreciate in value. Put options will depreciate, will decline in value. Call options we would buy if we hope the stock will go up. Put options we buy if we hope the stock will go down. Therefore, we may buy a call option again if we believe the stock will rise, or buy a put if we think the stock will go down. Conversely, we can also sell option contracts. If we believe the stock will go down, we could either buy a put or we could sell a call. Selling a call is basically the same thing as selling short the stock. Well, it's not the same. It actually has a different mechanism to it, but it accomplishes the same thing. If we sell short a stock and it goes down, we make money. If we sell a call and the stock goes down, we also made money. Conversely, if we think the stock will go up, we could either buy a call or we could sell a put. Selling a put allows us to make money if the stock goes up. That's price. Now, the second element in trading options is known as time. Time is one of the most important aspects of trading options because all options have all option contracts have a finite amount of time. All option contracts expire. Typically, option contracts expire on the third Friday of every month, known as options expiration. However, we also have what are known as weekly options. Weekly options expire every Friday. They're issued 7 days, or actually 8 days prior on the Thursday of the week before, and they're open, they exist only for 8 days. Weekly options are new. They're available in the most actively traded stocks like Amazon and Apple and the spiders as well. And they really give us a lot of opportunity, a lot of possibility for short-term trading. Day traders love to use weekly options. The further out in time that we buy an option contract, we could buy an option contract with 1 month in time value left, 2 months, 6 months. We could buy an option contract that has more than a year's amount of time. That's considered a leap. The more time involved in an option contract, generally speaking, the more expensive that option contract is because we're buying more time that increases our probabilities of being right. For example, if XYZ stock is currently $50 a share and we want to buy an option contract, a call option with a 60 strike price, meaning we'll start to make money if the stock goes above 60, well, that option contract for 1 month might not be very expensive because the probability of the stock going up to 60 is not that great in the 1 month. If we buy that option contract that has a year's time left in it, it's going to be a lot more expensive because we're buying ourselves the probability to make money over a longer period of time, over a year. Generally speaking, traders look to sell the front month options and buy longer-term options because the time value decreases at the fastest rate on the near-term options. The front-month options are the options that are set to expire the soonest, such as this month's options are in August. They expire the third Friday, which is this Friday. And those option contracts in August will decline at the fastest rate. For example, we see here, this is known as time decay. As we get closer to options expiration, the option contracts begin to lose value at a faster rate exponentially. If we have an option contract that goes out a year in time, the difference between 1 year and 11 months, we won't notice much of a difference. However, the decline in that value of that option contract between the last week is very, very significant. And this equally applies to calls and puts. Now, we talk about the options, there's a directional sign to it, meaning if we buy a call, we hope the stock will go up. If the stock goes up, then the call options will go up in value, the puts will go down in value. But time decay is not directional. It's only according to time. If you think of a stock chart on the x-axis, meaning the bottom axis, from left to right, from January to February to March, throughout the entire time value of the chart, the option contract will decline the value as we proceed forward in time. If the stock, the underlying stock, goes up or down, that will also affect the option. So there's two different elements to the option contract we've discussed so far. For example, let's consider the following example. On April 26th, which is when we took a snapshot of these prices, we looked at the SPY, the spiders, the S&P 500 index. It closed at a value of $158.24. At that moment, we priced the following call options with a 158 strike price. Remember, the call options go up in value if the stock, the spiders in this case, go up in value. Well, the weekly options that were set to expire the first week in May, we only had 1 week left. It gave us the right to own the spiders at $158 a share. The stock was $158.24. Those options were trading at $1.05, which means if you wanted to buy the call option that gave you the right to own the stock at 158 exactly, 158.00, and the stock was 158.24, you would have had to buy, you would have to spend $105 or $1.05 per share. Every option contract represents 100 shares, so $105. Why is it, and I'll ask all of you this question, why is it that if I have the right to own the stock at 158 and the stock is at 158.24, why is this option contract not worth 24 cents? Why is it worth more than 24 cents? Why is it worth $1.05? How do we account for the difference between the two? The answer is the extrinsic value. In other words, the time. The extra, does everybody see how that works? If we want to just buy the stock, we pay $158.24 per share. If we want to buy the option that gives us a right to own the stock at 158, we have to spend $1.05 extra. Why? Because the stock might go up. It might be worth 159 or 160. Therefore, giving us the right to own that stock at 158, we have to pay a little bit extra. Now, if we wanted to buy more time, if we wanted to buy the May options, it would expire on the third Friday of the month, it would cost us even more, $1.87. If we wanted to buy the June options, it would cost us $3.07, July $3.65, on down to the January of 2014 options, that would cost us $7.11. The more time that we buy, the more expensive those options are. But that's not necessarily a bad thing. Sometimes what we want to do is we actually want to buy more time. We don't know. It's very difficult to buy an option contract and say, well, I know for sure, or I have a very good idea that the stock is going to go up very soon. If we think of, and I'll ask all of you, I'm sure we could name, if I would ask you, name 2 or 3 stocks that you think will go up in 1 year. What stock do you think has a pretty good chance of going up in a year from now, between now and next year? August 14th of 2014, I can name a few stocks I think would go up. Tesla is one. Ford, IBM, any of those blue chips. Any others? Amazon.com, maybe Apple as well, Google, quite a few. It's not that difficult for a long-term investor to pick a stock that we think will go up over a long period of time. That's why day trading is so difficult. Name a stock you think will go up in the next 10 minutes. That's very difficult. That we have to be almost exactly right. So the more time we have in our options contract, the easier, the higher probability it is we're going to be right. But in order to buy that higher probability trade, we obviously have to spend more money. Everybody follow so far? Questions at all? No questions means we're doing a good job. Want to do a quick audio video check? Want to make sure everybody can hear me as well? Please let me know. I just want to double check. Want to make sure there's no audio issues. Excellent, excellent. Thank you very much. All right, moving forward. The third element of trading options is known as volatility. Volatility is a measurement of the rate of oscillation over a given period of time. Oscillation is very simply the up movement to the down movement. When the underlying stock's volatility increases, those options tend to rise in value. When the stock's volatility declines, those options tend to fall in value. Therefore, traders look to buy options when the volatility is rather low and they're inexpensive. Low volatility means the options will be less expensive, will be a bargain. When volatility is high, they tend to be very, very expensive, and traders like to sell expensive options. Think about it this way. We have a $50 stock. I'll draw a little chart over here to help illustrate the point. This is very important, by the way. We have a stock that's $50 a share, right? It has a relatively low degree of volatility. Maybe it goes up to 55, and maybe it'll go down to 45, right? What are the chances that the stock is going to go to 100 anytime soon? Not very high. Therefore, if I want to buy an option that gives me the right to own the stock at 50, an option that gives me the right to own the stock at 100, what's the probability of it going up to 100? Low volatility, very, very small. Therefore, it's going to be a lower price option. Conversely, if we have a stock that, again, it's $50 a share, and it's very, very volatile, this is maybe $10 a share, and this could be maybe $90 a share, and we buy an option that gives us the right to own the stock at 100, that option is going to be more expensive. What's the probability of the stock actually going to 100? A lot more expensive. Therefore, the more volatile stocks like Tesla and Google and Apple, Amazon, those options, generally speaking, are very expensive. Why? Because the volatility is greater. Question, which of the Greeks represents volatility? It's Vega. The easiest way to think about it, by the way, is something we cover in our workshops and courses. We talk about the Greeks, and they're the calculations that we use to quantify exactly what the state of volatility is. I always think of volatility in Vega because they both start with V. Delta equals direction, meaning the stock goes up or down. Direction. Time is theta. It's an easy way to remember that. Time that starts with a T, theta. V that starts with the Vega, the volatility starts with a V, Vega. Direction starts with a D, delta. Delta, Vega, theta. These are and there's actually a lot more, but these are the three most commonly used Greek, we call them the Greeks. They're the measurements that help us quantify exactly how expensive or inexpensive it is. Delta shows us the relationship between the stock price and the option price. If the stock has a delta of 0.5 and the stock goes up $1, the option contract with the delta of 0.5 will go up by 50 cents. It shows us the relationship between how much, if the stock goes up $1, how much an option contract will go up. Time is represented by theta. It's always a percentage or a decimal. If a stock option, a contract has a delta of 0.2 or 20 cents, it means every day that goes by, that option contract, whether it's a call or put, will decline in value by 20 cents. Shows us how much that stock option, the option contract, will decline in value every day. And Vega is volatility. It shows us, based on a 1% change in volatility, how much an option contract will go up or down in value. If the option contract has a 20% rate of volatility, or a Vega of 20, I should say, and the implied volatility, the state of volatility in that option contract goes up by 1%, that option contract will go up, it will increase in value by 20 cents. The Greeks are crucial when trading options because it shows us which contract is the best contract to buy or sell depending on what our expectations are. Here's another way to look at volatility, by the way. A way to approximate volatility if we don't use the Vega, the Greeks, is to very simply use the Bollinger Bands. The Bollinger Bands is very simply a 20 simple moving average extended 2 standard deviations above and below the center. When volatility is low, the bands tend to contract towards one another. When volatility is high, they tend to expand. When volatility is high, the options are more expensive, generally speaking. When they're low, it means the options are inexpensive. But this is only an approximation. The actual true way, the best way to price in the state of volatility is with something we call implied volatility. Every option contract, call this IV, implied volatility. The implied volatility is a percentage, and it's different for every options contract. It may say 70% or 20%. If it's a low number, it means the option contract is relatively inexpensive. If it's a high number, it's considered very or more expensive. And again, traders like to buy options that are inexpensive and sell options that are more expensive. So the Bollinger Bands is a nice, easy way to approximate if those options are cheap or expensive. But if you really want to do it the right way, we look at the state of volatility, the implied volatility, and we look at the Greek, specifically Vega. And that will tell us if it's a good deal, if it's a bargain, or if it's very, very expensive. Now, we put all 3 elements together: price, time, and volatility. In the first example, and this will help determine if the stock option is appropriate, or what is the appropriate strategy. Example number 1, we're bullish. We think the stock is going to go up. There's a low state of volatility. And in terms of the time horizon, we think the stock is going to go up soon. What would we do? We would buy a front month. The front month is the option that is set to expire the soonest. Call option gives us a right to own the stock, and we want to buy a call if we think the stock is going to go up. So if we think the stock is going to go up, we're going to buy a call. The state of volatility is low, which means we would buy a call. I'll ask all of you, what's another way to make money other than buying a call? If we think the stock is going to go up, but we don't want to buy a call, what's another way to make money? If we're not going to buy a call, then what would we do? This is the first quiz question. I know there's some option pros here that trade every day. Exactly right. Excellent. You'd sell a put. Does everybody see how that works? If we think the stock is going to go up, we can either buy a call or we can sell a put. Well, which do we do? Vega, or volatility, helps answer that question. If the volatility is low, we want to buy options, calls or puts. If the volatility is high, we want to sell options. So in this case, we're bullish, which means we either want to buy a call or sell a put. Well, which one should we do? The volatility is low, buy a call. Which should we buy, a long-term option or a short-term option? Well, in the near term, we probably want to buy a short-term option, an option that will expire soon. The other reason being is that if we buy a long-term option and the stock goes up, we're not going to make as much money. Return on investment. The shorter-term options give us a better ROI, return on investment, because they react more closely with the actual change in the stock price. Example number 2, we're bearish. We think the stock is going to go down. There's a low rate of volatility, and we think the stock is going to go down soon, in the near term. So what do? We buy a front month put. It's the same as a prior example, except we're bearish. We think the stock is going to go down. We could either buy a put or we could sell a call. Well, how do we know which one to do? We look at volatility. If the volatility is low, we buy an option. If the volatility is high, we sell an option. So in this case, if volatility is low, we buy an option. Which option do we buy if we think the stock is going to go down? A put. Long term or short term? We look at the time horizon, near term. This is a way, by the way, it's a little bit speculative. Actually, it's very speculative. But this is a way that traders use to play earnings. Swing trading earnings. What if we're trading, XYZ stock and it's going to come out with earnings in the next couple days or next month? But we don't want to hold the stock overnight because, the stock could open at a very, very different level than it closes if really good or really bad earnings are released. Well, what's a way to minimize our risk? We would buy an option. If we think the stock is going to explode higher, we buy a call. If we think it's going to go down, we buy a put. The amount of money we spend, by the way, to buy a call or buy a put, that's our maximum risk. We can't lose more than we spend on that option. So if we think the stock is going to go up, we buy a call. We might spend $1 per share, $100 on that option contract. If the stock goes to zero, we're only going to lose $100. But if we were to buy the stock, we would lose a lot more. 100 shares times $50 stock, we might lose $5,000. So it's a way to speculate during earnings season while very much minimizing our risk. Example number 3. We're bullish on the stock. We think it's going to go up, but this time the volatility is high. And we think it's going to go up in the near-term future. Well, because the volatility is high, I don't want to buy an option. I don't want to buy options that are already too expensive. I know this because of the volatility. So I'm going to sell an option. Which option do I want to sell? If I think the stock is going to go up, I'll sell a put. Which put? Long-term or short-term? I'll sell the front month puts. Again, remember, the puts, the front month is the option that will expire the soonest. And those puts will go down the fastest in value because time decay declines at the fastest rate when we get closer to options expiration. Example number 4, we're bearish on the stock. We think it's going to go down, high volatility. We think it's going to happen soon. Well, for bearish, we either want to buy a put or sell a call. Which one? Volatility will answer that question. It's high, so I'm going to sell options. Which option do we sell if we think the stock is going to go down? A call. We sell a call. Which contract? The front month, the near-term options. Any questions so far? I know we're kind of going through this fast, but I think it's pretty easy to grasp, right? Please stop me if there's any questions at all. Next example. We're bullish. We think the stock is going to go up, low volatility. Well, if we think the stock is going to go up in low volatility, we can either buy a call or we sell a put. But the low volatility means we're going to buy a call. Buy a call. Which kind of call? A short-term or long-term call? Long-term, long-term. You can see, once we know this little exercise that we go through will help determine what is the appropriate option contract to trade. Whether it's a call or a put, long-term or short-term, based on price, time, and volatility. Price is direction, time is time horizon, and volatility. In the next example, if we're bearish with low volatility, what do we want to do? We could either buy a put or sell a call. With low volatility, we want to buy an option. Which option do we buy if we think the stock's going to go down? A put. Which one? Long-term. Next example, we think the stock is going to go up with high volatility. Buy a call or sell a put? Not sell a put. Sell a put. Which one? Long-term or short-term? Well, we actually have the choice. We could either sell a long-term or short-term. Personally, I'd actually rather sell a short-term because we get the most bang for our buck, meaning that those short-term options will expire, will decline in value the fastest because they're closest to expiration. We could sell the August options, and as soon as they expire, we could sell the Septembers, and when those are done, the Octobers, and so on and so forth. So we actually have the option here. And then finally, we're bearish in the stock, high volatility. It means we're going to sell an option because it's high volatility. We're bearish, so we can sell a call. Long-term, time horizon, that means we could sell a long-term or short-term option. I would prefer to sell a short-term call and to do it over and over again. Questions at all? Everybody's an expert now, right? It's easy stuff. This is actually just the basics. It actually gets a little bit more involved. No questions at all? Everybody studied? Okay, good. Quiz number 1. Type the answers in as fast as you can. If over the long term we have a bearish outlook on XYZ stock, we think it's going to go down. And it's currently trading in a very quiet trading range with a low degree of volatility. What may be the appropriate option strategy? Long-term, bearish, low volatility. I see your question, Eric. I'll answer that right away as well. Who has the correct answer the soonest? Long-term, we think the stock will go down. Low volatility. Exactly right. But which put would we buy? Would we buy a short-term put or a long-term put? It's very important to identify our time horizon, because if we buy a short-term put, that put might expire worthless. The stock might not move. A very good example is August. I could think of a few stocks I think that go down over the long term. Maybe they'll go down by December. But if we buy a short-term option contract, the stock might not move in August, might not even move in September. So we buy a longer-term put. And by the way, I don't really like to buy short-term options on their own, to buy a short-term call or a short-term put, unless the volatility is very low and we think the stock has a really good reason to explode, to really have a big move soon, meaning earnings, or September 10th, Apple is going to announce a new iPhone, some kind of predictable event that can make the stock move. Because, that time decay hurts the theta hurts those short-term options to the greatest extent. So, we want to be very careful. So the correct answer is to buy a long-term put. Everybody see how that works? Going back to your question, I'm curious about the relationship between weekly options and week 3 options, meaning the standard options that expire on the 3rd Friday of every month for the same stock. Do the longer-term horizon extrinsic value or open interests generally make the 3rd week options more expensive? It's a great question. The standard options that expire every third Friday, the 3rd Friday of every month, they're generally speaking, they're more expensive than the weekly options are going to expire the soonest. The reason being is that we're simply just buying ourselves more time. We have a greater probability for the stock to move in our favor the longer amount of time we have. I hope, does that answer your question, Eric? Maybe I misinterpreted. In terms of the extrinsic value is the extra premium that we have to pay. For example, the stock is $50 a share. This is a stock. It's $50 a share. We might have a call option with a 55 strike price. Well, if the stock is 50 right now, and if I were to buy the 55 call option, how much is this worth? It's actually worth 0. The stock is at 50. If I want to buy the stock at 50, I'll pay 50. Why would I want to pay anything that gives me the right to own the stock at 55? But it's not going to be 0. It'll be worth maybe 50 cents or $1. Why? That's the premium. That gives us the right, because we don't know. The option buys us the availability. What if the stock goes to 60 or 100? We have the right to own the stock at 55. That's, by the way, called extrinsic value. Extrinsic is the premium that we pay. Extrinsic value, most of it is mostly time. Extrinsic value is another way of saying theta, or time. The more time, the more extrinsic value, the more premium. Intrinsic value would be if we had bought an option that gives us the right to own the stock, at 45. The stock is at 50, but I want to buy an option that's worth 45. How much would I pay for that? I may pay $6 for that. Say, wait a second. If I want to buy the stock at 50, why would I want to buy an option that gives me the right to own at 45? Because 45 plus 6 is 51. Isn't it cheaper just to buy the stock? Yeah, it is. Except that I will always, as long as this option contract exists, I will always have the right to own the stock at 45. What if it goes to 60? I could exercise that option contract at 60 and buy the stock at 45. So that'll be worth 15. Intrinsic value is, in terms of call options, is below. Extrinsic value is the time, the extra time premium. It's above. Everybody see how that works? I promise, I know there's a lot of terminology and some of you might not be familiar with. I promise, once you get a handle on it, it's extremely easy to get your hands on. Question number 2. Again, type in the answer as fast as you can. In the near-term future, we believe XYZ stock will appreciate in price. It will go up. And it's currently trading in a highly volatile manner. What may be the appropriate option strategy? Again, in the near-term future, the stock's going to go up or bullish. Whoops. And it's high volatility. What would we want to do? Well, if we think the stock is going to go up, we can either buy a call or sell a put. What helps us determine that? The degree of volatility. When it's high volatility, we want to sell options. You're exactly right. We'd want to sell a put. Sell a short-term put. Exactly right. Short-term is near-term. We'd want to sell a put. 100% correct. Guys are good. Question number 3. If we believe XYZ stock, which is currently trading in a quiet trading range, and it's going to report very negative earnings in the next few days, what might be the appropriate option strategy? It's low volatility, quiet trading range, and in the next few days, short term, we think the stock is going to go down. Near-term future, low volatility, what we want to do? There's actually more than one correct answer. You are correct. We could buy a long-term put if we believe that the bad earnings will translate into long-term trend to the downside. But in terms of the return on investment, the short-term options are more volatile. They'll react faster. You're going to make more money in the short-term options. But that means the stock has to go down. It has to go down. There's the risk-reward versus the probability of success. You know, remember, we have short-term options and we have long-term options. It's always a compromise in trading. We have a probability of success and we have the return on investment, how much money we're going to make on it. Short-term options, what's the probability that we're going to make money? It's actually a low probability we're going to make money. It's very hard yet to be exactly right with short-term options. You have a higher probability of success long-term because you have more time to be right. But the return on investment is going to be better on the short-term options. You pay for that you're going to get a better payout because it's a more difficult bet to make. But in the long-term options, we have a higher probability of being right, but the payout will not be as great. It's the same thing in terms of, if we're betting on sports. If you want to place a bet on the first-place baseball team, well, you're not going to get very good odds. You're not going to get a very good payout because the first-place baseball team is the best. But If you want to make a bet on the last place baseball team, you know, the horse, the long shot, the horse that is definitely not going to win the race, you might get a great payout. But what's the probability of being right? Not that good. And it's a different style of trading. Personally, I like to play it more conservatively. I like the higher probability of success. I'd rather buy the long-term options. I know I'm not going to make as much money, but I think over the long term, I have a better chance of making money. Number 4, if we believe the XYZ stock, which is currently trading in a very volatile manner, and we believe the sell-off will go down in the next few weeks, meaning short term, what may be the appropriate option strategy? It's very volatile, and we think the stock is going to go down soon. Short term, high volatility, bearish. What would we do? Bearish, high volatility, short-term time horizon. Who has a correct answer first? This is a tough one. Sell a call, exactly right. But we sell, remember, we want to sell a short-term call. Sell a short-term call because time decay affects the near-term options the fastest. Think about it like this. We have this is now, and these are 6-month options. These are 3-month options. These are 1-month options, and these are the weekly options. As we get closer to expiration, the 6-month options won't decline that much in value. So the 3 months. From the 3 months, it'll go down faster to the 1 month. And then we get to the weeklies, it's going to go down very fast. I didn't draw that exactly right. But the time decay, the value of the option starts to fall faster as we get closer to options expiration. So especially if we think the stock is going to go down soon, sell a front month call, a short-term call. Questions at all? What's the next step? Let's think about putting together a trading plan. Well, number 1, with any trading plan, what we want to do is visualize what we're trying to accomplish. What type of strategy best suits not only the current market condition, but also our personality in terms of traders? I assume there's probably quite a few day traders here, right? Well, how do day traders trade earnings season? We look to expect volatility, right? Stock comes out with earnings, it's up $10, maybe we buy, we look for prints, the bid, the offer, level 2, level 3. We expect the stock to be very volatile, right? That's in July. Earnings season in July. This is July, right over there. That's August. Earnings season is in July. And the stock market tends to get very volatile during earnings, and then in August, the stock market falls asleep. So in July, what's the technique? We're trend traders. We tend to, try to buy a trend going up or sell a trend going. We should. But in August, 2nd and 3rd week, 4th week in August, when all the earnings are out, the stock market, it's not really a very typical year this year, but you'll see the last week or so in August, the stocks tend to get very, very quiet. Then it's a little bit safer to use a buy low, sell high approach. Well, in terms of options, remember, we talk about volatility. When volatility is high, we want to sell options. So while intuitively we would think, oh, well, July earnings season, high volatility, I want to buy a call if I think the stock is going to go up. Well, that's to an extent, but after a while, when the stock options get so expensive, towards the end of earnings season, we actually want to sell volatility. We want to sell calls and sell puts. And then towards the end of August, when the volatility gets very, very low, and then we expect, the next big move might be big volatility in September or October, we want to buy options, buy calls and buy puts, expecting the next explosion of volatility. buy low volatility when we expect it to go up, sell high volatility when we think it's going to go down. It's a very good one. Are we able to use a paper trading account for options? And the answer is absolutely yes. I would highly, highly recommend it. I like to use Thinkorswim platform. They have a really great platform that has a paper trading, a demo account. I 100,000% recommend opening up only a paper trading account, a practice account first. Write down a piece of paper strategy, practice that strategy. I never trade a strategy on live account with real money until I can prove to myself I've made money consistently on the demo accounts. There's no reason to risk real money unless we know for sure, we're doing the right thing. And with options, it does take practice. I've heard that an option's going against you, you should get out at half or half price. There are different rules. Look, if there are certain traders, and it really does, it's a great question, it does vary from one trade to another. Some traders will say, look, I just want to buy calls or buy puts on earnings season. Some traders will say, you know what, my maximum risk is the entire price of the option. I'm going to buy an option for $200, and I'm either going to make a lot of money or that option will go down in value to zero. So I'm just going to risk $200. With the worst case scenario expectation, I'll lose the entire amount. And then we can say, okay, I don't want to risk more than $200 because $200 is 2% of my entire account. Or traders may say, well, I'll spend $200, and if it declines down by 50%, I'll get out. That's also a valid approach. That, I think, is a little bit more risky because you know what? Options, they can move very, very quickly. If the stock, you look at the stock like CRE, C-R-E-E, I think it's down a lot today, right? You might buy an option for 200 and it gaps down overnight. That stock could go directly to zero. You could place a stop order at $1, but you might not get a fill. So using stops, I don't like to use stop orders on options because a stop order is not a guarantee you're going to get out. And options also, they're not as liquid. There's not as much volume as stocks. Just because you put a stop order there doesn't mean you're going to get out that price. In fact, most times I don't think you will, unless the option has a tremendous amount of volume and it's not very volatile. My personal rule of thumb is that I never, whatever I spend on the option, I assume that's my maximum loss. If I have a $2,000 account and I don't want to risk more than 5%, and that's my absolute maximum risk per trade. If I don't want to risk more than 5%, 5% of $2,000 is $100. That means I'm not allowed to spend more than $100 on an option. Therefore, worst case scenario, if everything goes completely wrong, my account will only go down by 5% maximum. Does that make sense? But always try to match the strategy according to the current market conditions. Trade the charts that we see now, not what we think. I mean, it's helpful to anticipate what we think could happen, but trade the charts that we see now. What kind of volatility do we have right now? What's our time horizon? In terms of time horizon, another helpful suggestion, I think, always buy yourself a little bit more time. You may think the stock is going to go up in 2 days, but it might take a week. You may think it'll go up in a month, but you know Murphy's laws will go up in a month and a half. The stock will usually go up a little bit after our option actually expires. So I always like to look a little bit further out. If you think the stock's going to go up in the next couple of weeks, I'll usually buy a 3-month option. I don't like to own call or put options in the last month, really the last 6 weeks. The last 6 weeks are the most expensive 6 weeks, the most expensive time to own options. The other thing that we spoke about is selling options. And, we can't really, obviously that we're talking about just the basics here. But keep in mind, if you buy an option, if you buy a call or buy a put, whatever money we spend on an option is the maximum we can lose. You can't lose more than you spend. But if you sell an option, it's like selling short a stock. You need a margin account, and there's virtually unlimited risk. What if you sell short a stock, it's $5 a share, and it goes to 100? You could potentially lose 95 points. Well, with options, you could lose that money exponentially. So it's very important. I never sell naked options. A naked option is one option alone without any kind of protection. Meaning, if we're going to sell a call, we would buy another call as insurance. If we're going to sell a put, we'd buy another put. A common way to do so is something called an option spread. An option spread, very simply, is a combination of two contracts, usually the same type of option. We'll sell one call and we'll buy another. We'll sell one put and we'll buy another. A calendar spread, for example, are two call options that have different expiration dates. One might be an August expiration. One might be an October expiration. We have a vertical spread, which has the same expiration, but different strike prices. You might sell a 55 call and buy a 60 call. There's also diagonal spreads, which is a combination of the different strike price and different expiration date. And there's all different types of combinations. And, you know, an option trader will be able to pick and choose which calls to buy, which calls to sell, or which puts and calls to buy and sell. And they'll be able to construct the appropriate spread to take advantage of price, time, and volatility. It's a really beautiful thing when you get that down. You know, when you're able to get yourself on the right side of price, time, and volatility. And the most important advice I could give is practice, 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 and practice more. Practice makes perfect. Option trading, I think, is one of my favorite things to do in the markets. It's taken me a long time, you know, to try to get to where a point I'm comfortable. You know, and hopefully we can speed up that learning curve for all of you here, but it does require practice. It's not something that you can get in one day. The learning process is a wonderful thing, though. It's so fun. I promise you. You know, you put a little time. I'm a huge fan of, you know, doing the homework yourself. But you put in the time, I promise you, you will have those aha moments when you look at it, that the options contract, and all of a sudden one day you'll look at it from a certain angle and say, aha, now I see why that does that. Now I see why I should be selling this option and buying that one. In terms of price, time, and volume, it's a really, really fun way to be involved in the markets. And the potential money you can make is truly phenomenal. Question, when looking at the option chains, what should I be looking for to see if I should consider a stock option? Can you please show an example of an option chain? Well, I don't have the option the platform up right now, but I'll give you an example. Okay, so we have. Whoops, wrong color. Can't see that very well. Okay, we have. By the way, tomorrow, what we're going to do is we're going to actually look at the option chains. But I'll give you an example right now, okay? So we have the option, stock option. Let's do it this way. Sorry. Let's do it again. I don't have the platform running right now, but we'll have the root, which is the stock symbol, X, Y, Z. You'll have the option strike price, which is 50. We'll have the month, the expiration date, and that'll be August. And then you'll have the delta, which is the direction. That might be 0.5. You'll have the theta, which is how much time is left, or how much time decay, and that might be 0.2, 0.50, 0.20. You might have the vega over here, and that could be 0.1. And then you'll actually have the bid offer, the actual price of the stock. Okay? And that might be $2 by $2.25 or whatever it may be. Okay? And then when we look at the delta, what that does is if the stock goes up by $1 from $50 to $51 a share, that means the delta of the 50 means you're going to make 50 cents on that option contract. That $2 option contract will be worth $2.50. The theta is actually always a negative. It's 20 cents. That means if you hold the option for one day, that value is going to go down by 20 cents. And then V, which is volatility, Vega, shows us that the implied volatility goes up by 1%, you're going to make 10 cents on this. Let's say the volatility goes up by 1%. So if the stock in one day goes up $1, you're going to make 50 cents. In one day, you're going to lose 20 cents on theta, and it goes up by 1% volatility, you're going to make 10 cents. 50 cents minus 20 plus 10 is 40. So that option contract that was at $2 will now be worth $2.40. And the return on investment, well, that could be quite tremendous. That is just the very basics about how to look at the Greeks. But that's what we would look for on an option chain. Questions: if we wanted to trade options, should we have a background in stock trading? Well, you don't necessarily have to be an expert or a day trader in trading stocks, but I think you should have a basic familiarity with, technical analysis, reading the charts, whether you think the stock is going to go up or down. So yeah, you should have a general opinion about, how the stock moves and which way it can go. Yeah, but trading options, it puts another level to it. In terms of the Greeks, can you have a negative delta, Vega and theta? How would they work? Well, exactly right. It's a great question, I should say. When you buy an option, you have a positive delta. But if you were going to sell that option, you would have a negative delta. That means if you sell a call option, and it will vary between option contracts with the calls or puts, but if you sell a call option, you'll have a negative delta because if the stock goes up $1, you're going to actually lose money. Just like if you sold short the stock, you'd also lose money. In terms of theta, you lose money every day if you buy the stock, if you buy the call option. But if you sell the call option, you're actually going to make money off a positive theta. And in terms of volatility, well, if you buy the call option and volatility goes up, you make money. But if you sell the call option and volatility goes up, you're going to lose money. So you do have the inverse of those option contracts. Absolutely. Now, the homework for tomorrow, by the way, we're going to meet tomorrow, I believe it's 10 a.m. Eastern. What I want you to do is just very simply pick 2 or 3 stocks that you follow, pretty closely. It could be Amazon, Google, Tesla. We follow quite a few here. Very simply, try to approximate the state of volatility. You can look at the Bollinger Bands, for example, or just the candlesticks. Is the stock very volatile or not very volatile right now? And try to come up with an opinion. It can be a short-term or long-term opinion. Over the long term, I think that Apple's going to go up. Over the short term, I think Tesla's going to go down. Come up with 1, 2, 3 ideas like that. What we'll do tomorrow is going to look to the actual options chain. The Thinkorswim platform, we're going to look at the Greeks. We're going to look at the actual, measurements of price, time, and volatility, and we're going to try to discover together the best trades. By the way, we have brand new, it's actually not brand new, but it's still a very new social networking site here, my.cybertradinguniversity.com. That's where we discuss trading ideas for today. I post interesting articles and a lot of other good stuff there. That's at my.cybertradinguniversity.com. It's absolutely free to join. Moreover, for those of you that are not already members, we have our cyber group mentoring chat room that we host throughout the day, 8 a.m. throughout 4 p.m. Eastern. I kick it off at 8 a.m. Eastern with a Forex discussion. Stephanie comes on at 9 in terms of the stock market. And when we alter back and forth, we discuss options at 12 p.m. Eastern. And then Stephanie back on at 2. We basically follow the stock market, Forex market, and options market throughout the day in the chat room there. We come up with tradable ideas and a lot of other really good stuff. Cyber Group Mentoring Room, and that's available on our website as well. And then we have a workshop that we're hosting. I think it's coming up actually very soon. This workshop, if you're interested in the material that we spoke about today, but you really want to take it to the next level, I can see we've been talking here for about 59 minutes. and we didn't even scratch the surface. But if you really would like to master the Greeks, to know how to use delta, direction, theta, time, vega, volatility, and to be able to read those the right way and find the correct, not only the correct options, but then to be able to read those within the most commonly traded course spreads, calendar spreads, vertical spreads, time diagonal spreads, ratio spreads, butterflies, iron condors. That's a 4-option contract trade. Those are one of my favorite. This is an excellent way to do so. And these are some of the most actively traded spreads, so you can really use them during any market condition. That workshop will start August 19th and 20th, 10 to 2 and 4 to 6 on Monday, and then August 20th, Tuesday, 10 to 2, 4 to 6. So you have 2, 4, 6, 8 hours, and they'll be recorded as well. Normally priced at $189 for Cyber Group members. You save $50. Okay, that is available as well. It's coming up very soon. After this, I don't know when will be the next time we offer this, but I would say it's actually a very good time to take this workshop. Very simply, we're in the end of August. The Federal Reserve is meeting in September. Many expect the Federal Reserve may start to pull back on quantitative easing. Apple's releasing an iPhone on September 10th. We have a lot of really big economic events, in the next couple of months. Of course, everybody knows October earnings season, one of the best times of the year to trade. Using this rather quiet time of the year, August, early September, to practice option trading so that, we really have a solid trading plan. It can make all the difference in the world, especially with so many potentially really big market-moving events right around the corner. It's an excellent to do so. And again, it's only, within the Cyber Group member, only $139. It's a very, very low price way to get involved in the side of trading. Okay? If you have any questions, comments, concerns, you can always email me personally, call our offices, 877-70-CYBER. The phone number is available on our website as well. If you'd like a copy of this presentation, please email me, Adam at CTU, that stands for Cyber Trading University, Adam at ctutrading.com. I'll be more than happy to send off to you a copy of this PowerPoint presentation for your own viewing pleasure. And again, register. It's on our events calendar for day 2, which is tomorrow, 10 a.m. Eastern, day 2 of our options pyramid discussion. And that will be at 10 a.m. Eastern tomorrow morning. I thank you all very, very much for joining us. Fantastic questions. Always a pleasure. I hope that all of you will be able to join us tomorrow, 10 a.m. Eastern, for day 2. I hope to see you back soon. I wish you all the best of luck. I wish you all a great day.